folks, I think we'll get started now. We seem to have settled down with our numbers. You seem to all got in all right. So welcome to tonight's Farm Advisory Service webinar. I'm Laura Henderson and I'm going to be chairing tonight. This is our second webinar of the new Entrant Finance Course. We kick-started back at the beginning of this month with some in-person meetings in Lanark, Perth and Ayr. Lanark, Perth and Huntly. And then we had our first webinar last week on bookkeeping and VAT, where Andrew gave us an overview of all the paperwork requirements that we need to keep to be eligible for all our VAT returns and keep our accountants happy. The recording of that is now available on our YouTube channel, and the link will be sent to you again tonight. But I think those of you that were at last week's webinar should have received this link along with feedback for last week. So tonight it is understanding accounts and accounts analysis, and then we conclude this series next week at the same time on cash flow. So you can sign up on our FAS events page, but the link is there for your reference. And our guest speaker once again is Andrew Coalter, a chartered accountant who is a consultant with SEC Consultant based in Perth. Andrew is going to be doing all of these webinars with us, so we'll get to know him over the next few weeks anyway. So I think it's over to you, Andrew, now.
Perfect. Thank you very much. So good evening, everyone. As Laura's already said, my name is Andrew Coalter. I'm a consultant with SAC, but I'm also a chartered accountant as well. So I've been asked to deliver this series of meetings and webinars over the month of February. So this evening, we're going to have a look at your accounts, your annual accounts. What do they look like? How do we understand them? And more than understanding them, how do we analyze them? How do you know if what you're seeing is good or what you're seeing is bad? Having come from being an accountant who practiced in industry for a number of years, I was all too familiar with clients coming into their annual accounts meeting, looking a wee bit scared, nodding their whole way through. They wouldn't have any questions at the end and they would go home, probably none the wiser. So hopefully we can debunk a wee bit of that this evening. I do have a fair amount of material, which you'll see if you'd look at some of the slides in advance. So I'm going to go through at a reasonable pace. Hopefully any detail I overlook will be on the slides, and I'm happy to take questions as we go as well. There is a WhatsApp group set up as well for this cohort if you're watching it live. So if you remember that, feel free to drop other questions in there throughout the week, and we can keep on top of them as well. So what I'm going to do is I'm going to go through the structure of accounts, how accounts are generated, the key statements, which is the profit and loss and the balance sheet, and then we'll touch on how to analyze accounts a wee bit at the end. So a set of accounts doesn't matter if it's for an unlimited company, such as a sole trader partnership, or a limited business, such as a limited company. They all follow the same approximate format. Accounts are standardized. If you operate a limited company, your company has to follow company law and international accounting standards. There's really rigid accounting standards for how things have to be presented. Most agricultural businesses in Scotland are either sole trades or partnerships. That offers much more flexibility, and that's typically what we're looking at there. The layout might vary between accountants, but at the same time, those accounts still follow they're called generally accepted accounting principles. The theory is that you should be able to pick up a set of accounts from a business in Scotland or a business in Spain or anywhere else in the world, and they should be comparable because they are generated to the same approximate standards, which helps. I've talked about ethical responsibility here. Accountants do have to stick to a strict code of ethics that they've signed up to. So basically what that means is your accountant has to be really prudent in the information they're showing. They can't be knowingly inflating the figures or, diminishing the figures, for any particular gain. They have an ethical responsibility and a legal responsibility to show that information as accurately as they possibly can do. Different business structures affect accounts. So I've sort of touched on that already. If you're a sole trader partnership, the accounts will differ from those of a limited company. And to be honest, it means that you have more flexibility, and your accounts will probably be more useful in displaying management information to you. So just a quick note about the accrual basis and what this means. So almost all farming businesses get their accounts prepared on this basis. So basically what it means is that in your accounts, we record transactions based on when they occur, regardless of when that transaction hits your bank statement. So the example here is Morven sold seed potatoes worth £125,900 within her accounting year. However, she was only paid 15,000 for those. Because we work on the accruals basis based on the transactions when they occur, we would recognize 125,900 of income within that taxable year, even though she hasn't got got all the cash through till after the year end. So that's just something to be aware of. So any set of accounts that you see, whether it's for a partnership, whether it's for a limited company, whether it's an agricultural business, a construction business, an accounting business, it doesn't really matter. They all follow the same key format, and there's a key structure that runs through them all. So we have what's called primary statements. So that is our profit and loss statement and our balance sheet. Those are the two key statements or pages that you'll see in your accounts. And then we have some other information in there as well. Generally speaking, the main section that we look at is the supporting notes. So you've got your profit and loss and your balance sheet up at the front, and then at the back you might have 5 or 6 different pages of notes that are all numbered the whole way through, and they provide more detail about what's in each of those profit and loss items or what's in each of those balance sheet lines. So they provide more detailed breakdown of what is shown in those primary statements. So for the purpose of this evening, I will focus primarily on unincorporated accounts, what they look like, so a sole trade or a partnership, because that's going to capture the biggest number of people here. But the principles are the same regardless of your trading structure. A really common format that we see in agricultural accounts is as follows. So we will go through these in turn. So we're going to start with the profit and loss statement, and we'll go through each section of that, and then we'll look at the balance sheet afterwards. So within your profit and loss, ultimately, the basic formula you need to remember is income minus expense is your profit or loss. It's as simple as that. It can always be boiled down to that. But we display it a wee bit differently. So we will show the gross margins, and we'll get on to what that is, which is just your output less your direct costs. We have any other income you have, fixed costs, and net profit. Your balance sheet is really straightforward. It's just your assets minus your liabilities is the net worth of that business. And then we have the supporting notes from there. So if we take a profit and loss statement, what is a profit and loss statement in the first instance? So as I said, it can be explained any way to you, but it always boils down to the simple fact that income minus expenses equals your profit and your loss. Doesn't matter how complicated it looks, it always has to fit within that equation. So just remember that. So a profit and loss statement is a summary of all income and expenses within the year, within your accounting period, which is generally 12 months. There can be exceptions to that. Once you summarize those, you'll either have a profit or a loss. Normally, it's a 12-month period, and generally speaking, your accounts that you see will show a comparison to previous periods' performance. If this is your second year of trading or later. If this is your first year of trading, obviously you'll just have one line because this is your first time to produce a set of accounts. A really important point to note, and we talked about this last week when we were talking about what we can reclaim VAT on. The transactions that we see in a profit and loss statement are transactions that are wholly and exclusively for the purpose of a business. So if you have personal transactions, like you might be putting your groceries through the business bank account or whatever it is, you might be putting personal expenditure through there. That's not going to show up as a business expense because it's not wholly and exclusively for the purpose of the business. For things where there's a split between personal and private use, only the business and private use, only the business element would be recognized within your profit and loss. So effectively, the profit and loss gives a summary of everything that's happened within that 12-month period. It only contains transactions pertaining to the profit or loss of the business. So what do those transactions look like? In really simple forms, we've got our income. So all the things that you sell, all the income that you receive, whether that's rental, subsidies, whatever that might be. We take off your expenses. Your expenses are your direct costs, feed costs for livestock, seed, fertilizer, fuel, machinery repairs. We also have things like depreciation in there as well. The profit and loss statement doesn't contain any capital items. So by capital, we mean things like plant machinery or loan repayments. Those all go on the balance sheet instead. We're literally just looking at the actual income and the actual expenses. The purchase of assets, taking on new loans, that goes in the balance sheet. So yeah, ultimately, income minus expenses is profit or loss. It can always just be simplified down to that. So a couple of slides ago, I showed you how a profit and loss statement would be typically laid out. And this is really common within agriculture. So I will go through each of these sections in turn. So we start with our gross output. What is the output of our business? Is that your cattle sales? Is that your sheep sales? Is that your crop sales? And then we take your sales, less any purchases that you've made. So maybe you've bought in cattle, whatever it may be, and then any change in valuation. We've got your direct costs. Those are the costs that are directly associated with your production, with your output. And then we get your gross margin. And that'll be a gross profit or a gross loss. We then take in your other income, your fixed costs or your overheads, and then we arrive at your net profit. So your net profit is your profit at the end of the day after all expenses. So it's laid out a wee bit differently, but ultimately all of the income minus all of the expenses still equals the same net profit, the same profit or loss, no matter how it's laid out. So if we take gross output then and look at that in a bit more detail. So gross output is the core output of your business. So as I said, that could be your livestock sales, live weight or dead weight. It could be milk. It could be your crops, your straw, whatever it is that you're producing. We're looking at what your output is. And your gross output is not the same as your sales. So we don't buy and sell everything in 1 year. That's not how it works. Well, it might be in some businesses, but generally speaking, let's say we have a livestock farm. You're not buying a whole batch of cattle on the first day of your accounting year, keeping them for 12 months and selling them at the end. It's not that neat and tidy. So we need to factor in some of those changes. So the gross output is your sales for the year, less your opening stock that you had at the beginning, less your purchases, plus your closing stock. So what we're doing there is your output is basically how much you've produced, and then we add on any changes in valuations as well, because we're not buying and selling everything within a year. So that's our actual core output. This is what we're selling. This is what we're producing within a year. And then off our output, we deduct our variable costs. So variable costs in their simplest form are expenses that are directly linked to your output and that vary in proportion to that output. So if you keep more finishing cattle, you're going to have higher feed costs, higher medicine costs, higher bedding costs, whatever it may be. So those are direct costs that are linked to it. So those are the variable costs of that output. So there are some examples on the screen. It includes things like fertilizer, seeds, livestock feed, commissions, all those sorts of costs. Those are all variable costs that are directly linked to your production. So if we take the two of those together, what does that get us to? We've got our gross output, we've got our direct costs, and that will give you the gross margin or the gross profit or loss that you're making from your enterprise. We have a few other things to consider in your profit and loss statement, though. We have other income, and we also have your fixed costs as well. So in addition to your gross output, you're going to have other income likely in your accounts. So that's going to be your subsidies, like the basic payment or any grants that you apply for. You might have rental income, way leaves, anything else like that would be included at that stage. Then we include your fixed costs. So they're sort of the opposite of variable costs. Your fixed costs are costs that you're going to incur regardless. They tend not to vary that much with the scale of your business. So tractor machinery costs would be one of them. If you keep 10 more cows, is it going to affect it? Probably not that much. Your overheads like electricity, insurance, car repairs, your rental costs that you pay for grazing or for winter grazing for sheep or whatever that may be. Your bank interest costs. Those are all fixed costs that your business has to bear, regardless of how well your output does or how much your output is in the year. So then after we take off your fixed costs, we get to your bottom line. So your bottom line is your net profit at the end of the year. So it's just worth bearing in mind that there are differences between your gross profit and your net profit. So your gross profit is a bit further up. So we've got your actual output less the direct costs that are associated with producing those outputs. That gives you your gross profit. Your net profit is then your profit after all other costs have been removed. So we've accounted for all of your income, we've accounted for all of your expenses, and then we get your net profit, which is sometimes referred to as the bottom line of your accounts. So we talk, yeah, so that's your bottom line. An important thing to really think about, I suppose if you consider it for a minute, it becomes quite obvious that your gross profit measures the efficiency within your production. So if you've got your output less your direct costs, are you making a profit there at your at that sort of enterprise level before you begin? If you're taking, your livestock output and then you take off your feed, your bedding, and all the rest, and you're already making a loss, well then it's probably not that efficient a business, or there's something there that you need to consider. Whereas your net profit shows the farm's overall financial performance rather than drilling down into any specific enterprise. So, just so you don't have to listen to me drone on endlessly for the next half hour, I've got a quick exercise for you to go through. I'm only going to ask you to look at the first three. Hopefully, a poll will pop up on your screen shortly. But what I've got here is an extract from a bank statement, if you're able to see it. So there's loads of things that are coming in and out of the bank, and we've got money coming in from United Auction. There's some clothing from H&M. The next one's bank charges. Sterling Trailer Centre, somebody's bought a livestock trailer there. There's all these sorts of expenses. Um, so I want you to have a go at this and see if you can tell me for the first three, you might need to scroll down when you're looking at that poll, which of those transactions, where do these go in the profit and loss? And it might be the case that they don't belong in the profit and loss at all, in which case you can select the other. But what goes in the profit and loss? And where would you assign it to? So I'll give people a couple of minutes just to have a go with those first three. So the first one, there's £9,245 of income from United Auctions. The second one, £29.97 has been spent at H&M clothing. And the third one, £8.05 of bank charges. Good. Okay, so we've got 9,245 from United Auctions. I think you've all correctly identified that that is likely to be a source of income. H&M clothing, what could that be? Most people have said other. That's what I've gone with. I've assumed that that's a personal expenditure. It might be the case that you've gone to H&M and you bought some work clothes, in which case that could be considered an overhead. That might be the case. But more than likely in this case, it's likely to be a personal expense. So that goes in the other category. It's not going to show up in our profit and loss. The third one is, where do we put bank charges? There's a bit of a mix here. About a third of people have gone for direct costs, 2/3 have gone for overhead. In this case, Ask the Audience has got it right. That would be an overhead of your business. It's not really directly linked to your actual output. Let's say you're selling cattle. It's not really a direct cost we can attribute to an individual animal. It's just a cost of the business. So I've done that and gone through it for the rest of the transactions on this page. Sterling Trailer Centre there, for example. And we've paid out £7,500. We've probably bought a new asset there, likely a trailer, a cattle trailer or something like that. So I've put that in the other category because that's going to go in the balance sheet. Harborough is probably a feed cost. That would be a direct cost of your livestock production. A BT Group phone bill or whatever, or internet. Yeah, that's an overhead. Forth Valley Vets. Yeah, a veterinary cost would be a direct cost of producing your livestock. Just a quick point to note here, and it might seem fairly obvious. If we look at our bank balance here, we started at 4,800 and we've ended on 4,500. So actually our cash hasn't moved by that much. But there's been a lot of different transactions within this 1 month period in the month of January. It's just to note that cash is not the same as profit. So in this business, for the month, if we just took a really micro look at this month, in theory, we've made a profit of £7,000, but the cash has only moved by £200. So that's just helpful to note that just because your bank balance has gone up or down over the course of the 12 months, that doesn't equate to profit. And it's also important to note that profit doesn't equate to cash. It doesn't matter how profitable your business is. If you run out of cash, your business will die. So that's really important to note. So hopefully that was helpful. So that's a very quick run through of the profit and loss. I appreciate that was quite speedy. I'm just conscious of time more than anything else. So we'll go through the balance sheet. If you have any questions, stick them in the Q&A section and we'll get to them at the end. I'll go through the balance sheet and then we'll have a look at how we analyze accounts and how we know if we're doing okay. So the profit and loss gives us an overview of all the transactions that happen typically within a 12-month period. The balance sheet differs. The balance sheet is always made up to a specific date. So if your accounting date is the 31st of March, the balance sheet is a summary of what your assets and what your liabilities were on that date at a specific point in time. So whereas the profit and loss gives you an overview of the whole period, the balance sheet is just giving you a snapshot view of the business at that specific point in time. An important point to note is that a balance sheet always balances. What do I mean by that? Um, it means that the assets minus the liabilities, one side of the equation always equals the other, the equity or the net worth. So by adding up what the accounting records say belong to a business and then deducting what they say a business owes, you can identify what a business is worth according to those accounting records. The whole of financial accounting is really just based on that very simple idea. And it is actually known as the accounting equation. If you went and took an accountancy course, this would be accounting 101. This is the fundamental equation. Assets minus liabilities equals your net worth. The accounting equation is then expressed in one of these primary statements, which we call the balance sheet. So this is not, just a note, this is not the same as having your business independently valued if it were to be sold. Um, Items in the balance sheet are always held at their historic costs rather than their current values. But it's a point in time view of that business. All transactions within your accounts fit into this accounting equation. So even the things that happen through in the profit and loss statement. So if you buy a new tractor, your assets go up, but your cash goes down. So there's a movement in the asset section. But actually, if you sell some cattle, well, your cash goes up because you've sold the cattle, but then you've potentially made a profit. And a profit increases your net worth. So it's always in there. So all transactions, accounting, and bookkeeping fall into this equation somewhere. So that's quite helpful to note that the two statements, while they show different things, are intrinsically sort of fundamentally linked together. So what does a balance sheet look like? So we know that assets minus liabilities equals your net worth. We generally split this out a wee bit further when it comes to looking at a balance sheet in a typical set of accounts. Not that much further. We tend to just split it out into current assets and non-current assets. Now, current assets, generally speaking, are assets that we hold for the purposes of a trade that are readily converted to a cash, or assets that we hold onto for sort of a year or less. So we'll get on to examples of that in a minute, like cash, you're trading livestock, debtors. Non-current assets or liabilities are non-current, so they're basically held for longer than 1 year, whether that's a nice asset or liability. And they're generally long life assets with the intention of using them in the business, not with the intention of simply, reselling or buying them. So so basically the balance sheet gives you a really high level overview of each of these different categories. The notes to the account, which are at the back, will give you further detail on each of these sections as you go through. So let's take each of these in turn. So let's start with non-current assets. Quite often these are referred to as fixed assets. So these are long-term assets. They're not easily converted to cash. Your fixed assets is just your long-term assets of the business. So we've obviously got your land and buildings. That's a fixed asset. That's a long-term investment. We've got your plant and machinery. Sometimes we can consider breeding livestock as a fixed asset if you're using the herd basis. An important point to note is that the values that you see here are based on their historic cost, not on current market values. So the values you have in there for land and buildings might be lower than their current market value. So actually that's important when it comes to analyzing your accounts, or if you're trying to benchmark or compare yourself to others, make sure you're comparing like with like. Because if you've a farm sitting on your balance sheet that was bought 60, 70 years ago and is held at a really low value, you're not comparing like with like necessarily. Fixed assets are always held in the accounts at their cost, less their depreciation. So we recognize that assets have a finite useful life, generally speaking. We don't tend to depreciate land because land holds its value or increases. But lots of other assets that we do hold, like plant machineries, pickups, small tools, computer equipment, whatever it is, have a useful life. And therefore, over that useful life, their value decreases. The way we recognize that is through depreciation. So items that we capitalize don't go in the profit and loss statement. So we're not recognizing the expense for them, but how do we recognize the decrease in their value? We do that through depreciation. There's two main methods of calculating depreciation. One is called straight line depreciation, and the other is called reducing balance method. There's no right or wrong answer. You can use whichever one you want, or whichever one your accountant tells you or uses for you is absolutely fine. But this is what they look like. If you buy an asset at £1,000 and you say it's going to last me 5 years, you would depreciate about £200 a year. That's a straight line method. It's really even over time. Really easy to calculate, really straightforward. The reducing balance method, which is probably a bit more common, tries to be a bit more reflective of reality. In real life, if you buy a tractor and or a piece of equipment and you say it's going to last 5 years, it's unlikely to depreciate at a really steady, as market value is unlikely to follow that perfect track over time. What's more likely is it will lose a lot of value in year one, use a bit less value in year 2, year 3, and so on. So that's a reducing balance method. So it might be the case that we say it reduces by 50% a year. So here in the first year, we've dropped by 50% from 1,000 to 500. Another 50% of 500 would take you to 250, 125, 62.5, so on and so forth. So actually, we get down closer and closer to zero that way. So those are the two main methods of depreciation. It's worth noting that for tax purposes, depreciation isn't considered an allowable expense because that's something we can choose how we calculate it. So your accounting profit's not the same as your taxable profit, and that would get added back on. And if we can, your accountant would take off what's called capital allowances for any machinery purchases that you've made in the year. But that's a separate point. So that's our fixed assets. Our current assets are assets that are short term. They can readily be converted to cash. It might be the case that it is cash, the cash that you have in your bank account. The debtors, so that's people who owe you money, whether it's HMRC that still owe you for the last VAT return that you've submitted, you've sold something to somebody and they haven't quite paid you yet, whatever it is. Livestock generally come under your current assets. Any stock valuations that you have. So we're talking about your livestock, your crops, your fertilizers that you have in store at the end of the year. Those are all considered current assets. A quick note to make on assets, just when we are there, is the difference between partnership assets and personal assets. So it's quite common that in a farming partnership, the business might be run as a partnership, but the actual land itself might be owned by individuals. That's a really common thing to happen. If that's the case, generally what we see is that the farm wouldn't be shown in the balance sheet. All we would show in the business balance sheet are the assets that do belong to the business itself. Land is a really common example there. So that's just one to be aware of. So the business might have the use of the land, but if they don't own it, if it belongs to partners individually, it won't be shown. It might be the case that the partnership itself owns the land, in which case it would be shown. So we've got our assets. The other side of the accounting equation that we talked about is liabilities. So this is basically just what a business owes. So again, we've got current and non-current liabilities, or short-term and long-term. Short-term ones, your overdraft. If you've got any machines on hire purchase, the proportion that's due within the next year would be considered a current liability. Any creditors that you have any people that you owe money to, whether that's feed bills, electricity bills, whatever it is, accountancy bills. Long-term liabilities, that would be things like your bank loans, or any liabilities that you don't have to pay within the next 12 months, really. So hopefully that's fairly self-explanatory. So we've got our assets, we take off our liabilities, and the accounting equation tells us that gives us the net worth of our business, or what's called the equity. This is the other side of the accounting equation. Basically, if the business was to stop at this point, what is owed to the owners of those business? So the ownership of a business, so you as an individual, your ownership of that business is the residual claim to the assets after all the liabilities to third parties have been satisfied. So you might have a whole load of assets there, but if you've got loans to pay off and all the rest first, well, then they would need to be satisfied before you would be able to get your residual claim of what that business is worth. So that's the basic premise of it. If you're an unincorporated business or an incorporated business, it's slightly different. We talked about that in our first week when we talked about the legal structures and the sort of separate legal entity difference that we see for a limited company. So if you're unincorporated, there's no legal distinction between you and your business. You are the business. Even if you're a partnership, you are personally responsible for that. So any profits that the business make belong to you. They're your profits, you pay tax on them. So therefore, when we get to the equity section of the accounts, the equity belongs to the partners, and it's split between the partners based on profit sharing percentages, how much they've introduced, how much they've taken out. So really, your equity section is how much money capital you've introduced, plus any profit you've been allocated, less any drawings that you've personally taken out of the business. Slightly different for an incorporated business, a limited company. In this case, a limited company is a separate legal entity. Even if you own the business, the profits of the business are not yours. The assets of the business are not your assets. So in this case, the accounting equation still applies. Assets minus liabilities equals net worth. But that net worth, that equity, belongs to the limited company. So in a limited company, the way we see this demonstrated is rather than opening capital accounts, introduce profit shares drawings, what we see is the share capital. So that's the amount of money that the owners, i.e. you, have invested. So that might just be £100 if there's 100 shares at £1 each. And then all the profits that have been made are shown in one big bundle called retained earnings. And then out of the retained earnings, the company is able to pay dividends to its shareholders effectively. And so that's one of the ways you can extract money from the company. But fundamentally, the accounting equation still works. It applies in both scenarios. So in the unincorporated business there, I've talked about capital being introduced into the business. We add on the profit share, so what proportion of the profits you have. And then I mentioned there about drawings coming out of the business. So what are drawings? Drawings are the money that the owners, so if you're a sole trade, that's yourself, or if you're in a partnership, the partners take out of the business. So we all take out, we're going to take cash out of our business at some point. So you have to pay tax on the profits of that business, whether you withdraw that money from the company or not. But once the tax is paid and it's sitting in your capital account, that money is absolutely yours to do what you will. So you can leave it in there, you can use it for reinvestment in the company, or it might be the case that you need to take it out for whatever reason. So you could be taking cash out for personal use, whether that's to cover your living expenses. It might be the case that you've got personal bills that are going through the company. I mentioned earlier on that some transactions might have an element of business use and personal use. The business use is recognized as an expense of the business, but only the business portion, whereas the personal use portion of that invoice would be allocated as drawings against your capital account. That's effectively money that you've taken out. You mightn't have actually have taken money, but you've taken, goods in lieu of money instead. If you take out any goods for private use, so personal use, so let's say, I don't know, you put a lamb in the freezer, or you put a bullock or a heifer in the freezer every year, or you give away some assets, whatever that might be, that would be drawings out of your business. That's assets, that's value that you're personally withdrawing from the business itself. Private use, so if your electricity bills are going through the business, your private use share, farmhouse repairs, those sorts of things, a certain proportion of those would be considered a private expense rather than purely a business expense. So they would come out of the drawings as well. So that's a quick whistle-stop tour of a profit and loss, of a balance sheet. Those are the two key statements that we see in any set of accounts. What you're also going to see, and I'm not really going to go into it in much detail here this evening, just in the interest of time, is the notes to the account. So these are all the pages that follow on and give you the details of these headline figures that we see in the profit and loss and in the balance sheet. So for example, if you're in your balance sheet and you're looking at the non-current asset section, you're probably just going to see one total figure for the fixed assets. You're just going to see one value. Let's say it's £250,000. Great, we know we have £250,000 of assets, but that's not incredibly helpful. It would be more helpful to know what that is. So there will be a note in your accounts that will break down the fixed assets in more detail, and it will split it out to say off that 250, 100 might be from our land and buildings, 150 might be from plant machinery. And off that 150 value, we've maybe spent 350 and we've put in 200 of depreciation. So the notes provide all the details on what's going on in there. It will also outline what your depreciation rates. When you get to the capital accounts, it will show you how the profit has been split between the business partners, if there are any. Again, for your stock will just be shown as one total stock figure for everything on the face of your balance sheet. The notes of the account will break that down and they'll break it out to say, well, actually, so much of this was cattle, so much of this was sheep, so much of this was crops. And actually, it might even go further that and break it down into categories, depending on how much detail you want to add into your accounts. If you're a non-incorporated business, they're the accounts need to follow what's called the UK generally accepted accounting principles. But as long as they follow those principles, there's flexibility with how we display it. So if you want your accounts to display more information for your own purposes, that's absolutely fine, and you're absolutely entitled to do that. Which is why we see sole trade and partnership accounts showing much more detail than we would perhaps see in limited company accounts, and it's laid out in a much more agricultural specific format. So we've got our accounts. We've had a look through our profit and loss, which summarizes the transactions for all of your income and expenses for that 12-month period. We've got our balance sheet, which shows us at our year-end date, what was our position? What was the worth of our business on that year-end date? What were all of our assets? What were all of our liabilities? And we've accounted for them all. That's great. So then the question becomes, okay, well, am I doing good? Am I doing bad? How do I know? So we need to start analyzing these a wee bit further and analyzing our performance there. Doing a bit of a business health check to identify issues early. If you can look at your accounts and start to spot issues within there or identify concerning trends, that's a really positive and proactive way to be able to plan to resolve them. Looking at trends year on year is really important. Is your profitability going up? Is it going down? What's your cash position doing? Or is your cash position increasing? Should you be using some of that excess cash for other purposes? Actually, are you getting a wee bit tight for cash? Are you getting close to your overdraft limits? Is your debt creeping up and up and up every year without you really noticing? There's some really obvious things that you can spot just by having a quick look at your account. There are some key performance indicators that you can look at, and they can be whatever you want them to be for your business. We will look later on at some sort of financial ratios they're referred to as that you can use to sort of calculate some a few quick health checks on your business. Yeah, at the end of the day, I mentioned this already. It doesn't matter how profitable your business is. If you run out of cash at any point throughout the year, if you can't manage your cash flow and you run out and you can't pay your bills, the business fails at that point. So this is quite a common expression within the accountancy sector. Turnover looks really good. It might be nice to say, "Oh, I've had £1 million of turnover this year." Turnover is vanity, profit is sanity, but cash is the reality that we need. So let's actually start with our profit and have a think about that. How do we know? How do you know if your profit is enough? That's a question that I regularly get from people. I've made a profit this year. It might only be 2,000, it might be 5,000, it might be 100,000. That doesn't really matter. The question is, have you made enough profit? So the question really is, what do we need that profit for? So fundamentally, businesses need profit to cover the drawings of you as the owner of that business. The business needs to make enough profit to be able to satisfy your personal requirements out of that business. So if this is your only source of income, it might be that you're living day to day out of the profits of that business, and the drawings that you take out are covering, um, you know, your, your bills, your groceries, your rent, whatever that might be. So actually, the profit of the business needs to be enough to sustain you. Because if you're withdrawing more from the business than it's making in profits, what happens is that accounting equation starts to crumble a wee bit. Your assets minus your liabilities equals your net worth. But if you take your net worth is topped up by profit, but it's reduced by your drawings. So if you're taking out more than the business making, that worth of the business slowly gets eroded away. We also need to make enough profit to service our debt and our loans and start to repay our loans if we want to be able to repay them, and generally just reduce the amount of debt. Also, if we want to reinvest in our businesses, we need to be making a profit. If we're not making a profit, our net worth isn't growing, and if our net worth isn't growing, we don't have the funds available to reinvest and expand, buy new bits of land, build that new cattle shed, repair the sheep bank, whatever it is. So that's what the profit's needed for. This is going to be an absolutely personal thing. There's no right or wrong. It's not to say that small profit, is an issue, because actually that small profit might be sufficient for the needs of what that profit needs to do. Ultimately, net worth growth is a really useful indicator. I've sort of talked about that already. Just because a business is making a profit doesn't mean that it's a growing business. If the demands of profit are too high, it can still fail. And ultimately, that comes down to that's not necessarily a problem with profit, that's generally a cash flow problem. Understanding the need for drawing, how much is needed to reduce your debt, and whether depreciation is included in that expense will give you a guide as to what your target minimum profit levels will be. So that's maybe a good calculation rather than saying, is this a good profit? Well, what do you need it to be? And then work from there. And if your profit's not enough, you'll need to take steps to rectify that. I've talked about cash flow a few times and the fact that sort of cash is king here. We will cover cash flow forecasts, how to create those and how to monitor cash flow next week. So stay tuned for that one. So look at our accounts. How do we start to analyze them? A really good place to start is by analyzing how much profit you're making. And actually, what's your profit margin? Not only are you making a profit, what's your profit margin here? So this is really a measure, degree to which a company or enterprise makes money. So what is your profit margin? It's your net profit, which is your bottom line profit, divided by your output. So how much output are you making how much profit are you making in proportion to your output? And that tells you what your profit margin is. Is your profit margin 1%? Is it 5%? The more profitable something is, the higher your profit margin is going to be. So that's a useful place to start. A perhaps more common way of analyzing your accounts, and this is one I do regularly. If I'm presented with a set of accounts, this is quite quickly where I will go. I will look at the balance sheet and I'll go on to talking about that. But looking for problems in a business or actually saying, I know that I've got all this income, I'm happy with that. I know my expenses are high, but I don't really know which ones are high. This sort of gross output analysis is quite a helpful place to start. So what do I mean by gross output analysis? So your gross output, and we already covered, is your sales minus your purchases, and then we've got valuation movements in there. So what's your output? What's your production for the year? So obviously that your gross output is that's our starting point. So we say that's 100%. So your variable costs, a standard industry target would be that your variable costs are 30 to 40% of your gross output. So therefore, we would hope that you make a gross margin of between 60 and 70%. This won't work all the time, but these are sort of tried and tested targets that have been around for a very long time. We then sort of categorize the rest of your fixed costs, your overheads together into a few different categories. So labor costs, generally speaking, we'd be looking to see those in the sort of 15 to 18% category. Machinery costs, 15 to 18. Other general overheads, sort of 4 to 6% of your output. Finance, rent and rates, less than 15%, which leaves us with a net profit, fingers crossed, of around 15% of your gross output. So if you've got a gross output of £100,000, we're hoping that you're going to make a net profit of around up to about £15,000 or more, ideally. These aren't set in stone. These are very rough guides. It might be absolutely fine to deviate from these, but the important thing is to know why. So a common example might be that your power and machinery costs are massive. So what would that mean if your power and machinery costs are massive? That might mean a few things that you need to investigate. First of all, have you too much kit? Are you spending loads of money on financing kit that you could maybe do without? Is your kit getting too old? Are you spending a whole load of money fixing up kit that's becoming unreliable? It might actually be more financially responsible to sell that and get something newer if it means you're spending less on repairs. It might mean less downtime and things as well, so that might be a problem. But also you might have too much machinery. You might have a really high machinery cost because you don't have any help. You can't get that labor, so therefore you've geared yourself up with extra machinery. So it might be the case that your machinery costs are higher than average, but maybe your labor costs are lower. So it's not to say that these are set in stone and that if you're out with these targets, that's a problem. But if you are out with these sort of rough targets, maybe try and have a think, why am I out with these rough targets? And go from there. If your variable costs are a really big proportion of your gross output, I sort of said that earlier on that actually, your net profit, which is sort of below the line, um, is a measurement of your total financial performance, whereas actually your gross profit measures efficiency within your production. So if your gross margin is less than 60% or less than 50%, maybe there's inefficiencies in there. And those might be physical inefficiencies. Are your vet and med costs too high? Is there physical reasons why your vet and med costs are too high? Is there animal health issues you need to concern yourself with? Are your sheds and facilities not up to standard? Are they not, are they not getting appropriate attention? Whatever that might be. But using these as guides and then comparing it to your business is quite a helpful place to start. Okay, so yeah, gross output analysis gives an indication of any particular strengths and weaknesses you have. It might be the case that, your finance costs, your rent costs are really low. Well, that's great. That might just be a strength of your business that you can lean on, and that might result in higher profitability, or it might be able to cover up the fact that because of your specific circumstances, some of those other costs are higher. It helps highlight any particular problem areas. I've given a few examples already. There's any number that you'll be able to think through yourself. Is there any areas of the business that are doing particularly well? Could you focus on those? Could you maximize those and maybe increase that revenue stream if you know it's more profitable? 1 year in isolation is fine, but there can be one-off events that skew that. You might have a really bad scanning because there was a top that wasn't working, or there might have been some sort of disease problem, or there might be a really bad year of weather that just throws everything, and your fertilizer costs are really high and your crop yields aren't that great. Performing this across multiple years helps give a better insight into what's actually happening in the business. So if we then look at the balance sheet on the other side, a really quick assessment of the balance sheet without doing anything fancy can tell you a lot about your business. Look at your cash position. Is it going up? Is it going down? Are you in an overdraft? Is your overdraft getting bigger and bigger over the course of 2, 3, 4 years? That would tell you a whole lot straight away. Have you got really high level of borrowing? Not necessarily a problem, but if your level of borrowing is going up and you're not managing to get it down, maybe that's a sign for concern. Net worth indicator, I've talked about that a few times this evening already. Is your net worth going up or down each year? Is your debt increasing, reducing, static? What does that mean for your annual repayments? Are you able to make it? Are the creditors increasing? Those sorts of things. You can do a whole lot there without doing anything fancy. I've got three financial ratios is how I refer to these. I've got three quick ratios to help you analyze the balance sheet of a business. They're all in the notes, so if I skip through these too quickly, hopefully you'll be able to refer back to them, but hopefully I'll make them quite clear. The first one's really common, and it's what's the percentage owned ratio. I talked about that in the balance sheet, that your net worth is basically the residual value of your assets after all the liabilities have been settled, after all those third party liabilities have been settled. So what's your total equity divided by your total assets? This is really common. Monitor that year on year. Is it going up or down? If you're a tenant farmer, we're generally looking for that to be sort of 50% plus. If you're an owner occupier of your farm, we would hope, given the values that you have and not having to pay rent, etc., as much rent, we would hope for that to be sort of 70% plus. Something that gives a really sort of short-term view of the business is called the current ratio or the quick ratio. In really simplistic terms, what is the ability of the business to meet the current liabilities uh, using the current assets? So we talked about current liabilities. Those are debts that need to be repaid realistically within the next 12 months because we consider them to be current. Can we meet the liabilities that we have to pay within the next year, ideally from cash, but using our current assets? Can we use those assets, which could be liquidated, to pay off those debts that we owe that are due in the next year? Ideally, we want that to be over 100%. If we're doing well, 150, 200% would be the higher the higher your percentage is there, the better. But actually, if you're in a situation where your current liabilities much higher than your current assets, that's really a call to action to say, well, actually, how can I get this down? Do I need to think about liquidating fixed assets? Do I need to think about converting some of this debt into a loan? Other options there. That's something to consider. A third option here is to look at what we call the gearing ratio. So basically, this is the amount of debt that your business is relying on in proportion to the equity or the net worth of a business. So how much debt are you using to fund your operation? So by that, we're saying calculate the value of all your loans, all your hire purchase, all your overdrafts, all your actual borrowings, and divide them by the equity or the net worth of the business, and see what that is. It might be that your business, 50% of your business is propped up by borrowings. Um, Being highly leveraged isn't necessarily a problem. And that's often the case for sort of progressive, expanding businesses, young business. However, you need to be able to service that debt. That's the key thing to note. So really, you need to be able to keep up with the repayments and the level of interest that's being charged. The level of interest that's charged on borrowing money can be absolutely crippling to low profit businesses. A low profit business cannot afford to be highly geared. Lots of businesses are highly geared, larger progressive businesses or businesses that are growing, but you need to be able to make enough profit, as I said earlier, to service your drawings, but also service the debt and the repayments that we have there. So that's a few quick ratios. None of those ratios on their own will give you a complete view of the business, but hopefully they help to paint a bit of a picture. I appreciate our time is disappearing. So one other thing I wanted to mention was benchmarking. So you've got your own accounts, you've done a bit of analysis against those sort of standard percentages that we know about. But actually, it's hard to beat comparing your business to a similar business that you know of. If you don't have somebody who's willing to give you their accounts, or if you don't have somebody with a direct comparison, there's lots of useful data sets available already. The Scottish Farm Business Survey is a good starting point. That's an annual survey of 400 farms in Scotland, all different types. That is publicly available information. I appreciate it comes out about a year out of date by the time it's all processed. But actually, if you look for the Farm Business Survey, Scottish Farm Business Survey data, look for their whole farm benchmarks. There's lots of financial benchmarks there where you can actually compare yourself to the most comparable business and select your business type. If you're involved in the farm advisory service, you might be involved in some of the FAS discussion groups, or you might be involved in other discussion groups with other organizations. Those are often quite a good place for like-minded people to get together and to compare financial information in a private setting, in a trusted closed group scenario. Compare it with similar businesses. If you're really stuck on if you don't have anything, SAC Consulting produced what's called the Farm Management Handbook, and it demonstrates, at a gross margin level, standard industry profitability figures we expect to see over the next year. So you could compare your gross margin performance to that. Always make sure you're comparing like with like. That's the key thing there. But hopefully that's quite a helpful overview. Again, I've mentioned it before, there's lots of other information available on the FAS website. If you go to the new entrants/business skills section, there's plenty of information there about getting started in business, about accounts analysis, all these sorts of things, publications, webinars, video recordings, podcasts, etc. Thank you very much. I do appreciate that was a whistle-stop tour, but I'm quite happy to take questions if there are any.
Yes, thank you very much for that, Andrew. That's been quite insightful, and
Good.
hopefully we've all kept up with that, because I do appreciate that was a lot to cover, but you do have the slides and you
Yes.
will have the recordings to go back to. So we'll get kick-started with some questions, because there are a few here. We may run slightly over time, because I think it's quite good to answer some of these good questions that you've been putting through. So we'll start, Andrew, with last week when we did the bookkeeping and VAT, we mentioned some of the softwares that are available to help with bookkeeping. So
Yes.
can they be used to produce profit and loss statements?
Yes, absolutely. So any accounting software that you do will have functionality in that to produce a profit and loss or a balance sheet. And what I would say is that your accountant, if you're using an accountant, will make their own adjustments at the year end. There'll be a number of accounting adjustments they need to make, that might affect the format of it. But if you've put in all your transactions as you've been doing your VAT returns, there should be functionality within each of these pieces of accounting software to go into the report section, and you'll be able to run a profit and loss statement or a balance sheet. That's quite a useful thing as a management tool. You might actually want to go in and run a profit and loss statement every quarter or for every year or for whatever period you want, depending on what your business is. And you can run those yourself for multiple years and use those as sort of a management tool. But yes, absolutely. Almost all, I think all software that I've come across will allow you to do that.
Good, yeah. And certainly if you can use that alongside the benchmarking, like the Farm Advisory Service publishes the Farm Business Survey every March when that comes out. So it's always a good time, usually at the end of the financial year, just to run through these
Yeah,
things.
absolutely.
And then, Andrew, once your accounts are prepared by your accountant, what sort of happens to the next? Do they have to go anywhere? Are they submitted anywhere? What do we do with them?
So it depends on your business structure. So if you are an unincorporated business, so a sole trader, a partnership, your accounts don't actually go anywhere. So the accountants will make all of their adjustments. They will produce your annual accounts. And at that point, they just become a useful document for you as the business owner. But they need to go through that process and make all of their adjustments to arrive at the profit figure. And the profit figure that comes out of your accounts is the starting point for your accountant to calculate your taxable profit. There will be some separate adjustments made between your accounting profit and your taxable profit before they submit your tax return. But really, if you're an unincorporated business, your accounts are really just a vehicle to get to the right profit figure that accountants can then go on to use for the tax return. So HMRC don't see your accounts, they just see your tax return. If you're a limited company, it's a little bit different. If you are a limited company, you have to produce your accounts to international accounting standards effectively, and those accounts have to be published through Companies House, as I referred to in the first week. So actually, they become publicly available information in a reduced format, but they do become so they have to be reported to Companies House, which are just the branch of government who regulate companies, limited companies, and that becomes published equally as with unincorporated businesses. The profit figure in your corporation and your company accounts then go on to calculate the corporation tax that's due.
Right, Andrew. And then when we're still on our profit and loss, sometimes in a profit and loss sheet, there are figures in brackets. What does that mean?
Generally speaking, if there's a figure in brackets, it just means it's a negative figure. And rather than showing a minus sign at the start, sometimes we'll show positive figures just as a figure, and we might show figures in brackets as a negative figure.
Yes, and then moving on to our balance sheet.
Yep.
Last week we spoke about the herd basis for trading. What other ways are there for accounting for livestock if we don't want to use the herd basis? For instance, if we were starting up a new herd.
So the herd basis is a specific set of tax rules that only applies to breeding livestock. In that case, if you do apply the herd basis to your accounts, there are certain long-term tax planning advantages rather than anything short-term. So you can speak to your accountant about that, but your herd would be shown as a fixed asset rather than a current asset. What normally happens with livestock of any kind, whether that's cattle, sheep, goats, working dogs, they tend to just be just shown in your current asset section. So there will be a note in the accounts that will detail out what your stock is, but actually your stock is just shown as a current asset on the balance sheet. So they are shown as an asset on the balance sheet, they just sit under the current asset section.
Yeah, and then when we're looking at tax years, who determines the start and end date of that? Because recently we have gone through a bit of basis reform.
Yeah, so there's been quite a recent change here. So the tax year starts on the 6th of April and it ends on the 5th of April. That's a really, really historic thing from when we swapped to is it the Gregorian calendar we have? Back, I don't know when that was, hundreds of years ago. Basically, the government at the time didn't want to lose out on a couple of months worth of tax. So because at that point that was the start of the year, whereas now it's not. It's in the middle, it's at the start of April. So because of that really historic adjustment, we've ended up with the 6th of April rather than the 1st of January, which would make sense. So that is the tax year. It never changes. You can have your accounting year end whenever you want. Most people have an accounting year end of the 31st of March. For tax purposes, 31st of March and the 5th of April are considered the same thing. That's their 12-month period. So April through to the end of March. That's what most businesses have. It used to be the case that you would be taxed based on the profits you made within your accounting year, whether your accounting year ended in March or in September, quite a few people, or November was also quite a common one. That's now changed, regardless of when your accounting year end is, and you can have it absolutely whenever you want. You're still taxed on the profits that you make within the tax year, being 6th of April to the 5th of April the following year. So if you have a year end of, let's say, the 30th of June, within a tax year, you would be taxed from 6th of April to the 30th of June of one year and 1st of July to 5th of April in the next year. Which is why most businesses have now swapped to a 31st of March year end. So if you're starting up, to be honest, it's not really worth the hassle unless you have a really specific reason. Just go with the 31st of March year end.
Yes, great. And I think we'll make this probably our last question because we are now a couple of minutes over time. But when we're doing accounts analysis, in the gross output figure, we had labour and power and machinery separated. But if you were self-employed, working on the farm on your own or just using some family labour, do you need to include that figure in that calculation for gross output?
So if you're just using your own labor, there's not a monetary value. You're not getting an hourly rate, unfortunately, for doing that. So for the purpose of making accounts, no, you don't need to include that. However, if you're trying to benchmark yourself against other business, the question is, do you value your time? And you really should. If you're benchmarking yourself against other businesses to see how you're doing, most of those data sets will have included some sort of estimation of how much the labor cost would be. And that's to account for either your time or the equivalent of family labor. So if you're comparing yourself to the likes of Scottish Farm Business Survey data, something like that, you should really account in something to account for your labor. But in terms of making accounts and having your accounts at the end of the year, no, you don't need to account. The only labor cost you would need to account for is actual wages that you've paid out.
Yeah, and I think when I'm analysing some of these figures, I usually lump labour with power and machinery together, so it comes to almost 36%, just so that it accounts for these lower
Yeah,
labour farms.
exactly. Because generally, if labor's higher, machinery costs are lower, or if machinery costs are lower, labor costs are higher. So that's quite reasonable to do.
Yep. So thank you very much for that, Andrew. That's been really insightful tonight. And I hope our attendees have enjoyed it and left with a greater understanding of accounts and accounts analysis. Thank you for joining us tonight, and we hope to see you next week.